Hello, and welcome to this training on 2 CFR 200, the rules of federal grant eligibility. My name is Aaron Whitehead, and I am a compliance coordinator at Strategies to End Homelessness. Our hope in providing these trainings virtually is that they will offer better opportunities for the community to be able to attend these on their own time and with less trouble. Our hope in offering this training is to do the following: to increase familiarity with regulations governing eligibility, to improve the ability to distinguish between eligible and ineligible costs, and to increase institutional and community knowledge of eligible costs. While I would love to take the time to discuss every aspect of grant eligibility in detail, I had to pick a few main topics so that this presentation didn't take all day. Here is a summary of what we'll be covering today. Number one, we will cover the factors governing eligibility. There is a great section in 2 CFR 200 called Factors Affecting Allowability of Costs. These are the primary criteria that we will be covering today and are worth reviewing on your own time. The four we will focus on today are consistent treatment, necessary and reasonable, allocation, and adequate documentation. Number two, we will discuss a few costs that the regulations clearly say are not allowable to be charged to the federal grant. And number three, there are some areas that get their own special place in the regulations because they are so complicated. We will be discussing a few of the most important ones here today, namely salaries and wages, equipment, travel, and the period of performance. We begin with factors governing eligibility. These factors are addressed in 2 CFR 200.403. I should make clear that all of these criteria must be met for an expense to be eligible to be charged to a federal award. The first factor to consider is consistent treatment. I have included here specific definitions of two examples of how costs must be treated consistently. While I won't take the time to read them out loud, the short version of what they are saying is that an agency must treat costs consistently across federal and non-federal expenses and across direct and indirect costs. More generally, an agency's policies and procedures should be the same for federal costs as for non-federal costs. Also, for those agencies using an indirect cost rate, what you treat as direct versus indirect costs must also be the same for federal awards and non-federal expenses. Next, we will cover the requirement that costs be necessary and reasonable. First, let's discuss what it means for a cost to be necessary. Unfortunately, there is no specific definition for necessary in the federal regulations. There is, therefore, going to be a reliance on the good judgment and prudence of the person operating the federal award. Some helpful criteria as you try to make this determination are fulfilling the basic obligations of the grant, such as carrying out objectives, meeting goals, serving participants, and fulfilling the mission, and being necessary to carry out or accomplish these objectives. Again, since this is not specifically defined, feel free to reach out to us at Strategies anytime you aren't sure or think you're dealing with a gray area. And now to discuss the other aspect, reasonableness. Fortunately, reasonableness is defined in the regulations, although the definition itself still isn't super specific. The definition is, a cost is reasonable if, in its nature and amount, it does not exceed that which would be incurred by a prudent person under the circumstances prevailing at the time the decision was made to incur the costs. However, there is more discussion in the regulations that can offer you help as you're thinking about reasonableness. Per the regulations, a cost is reasonable if it is generally recognized as ordinary and necessary, it is for market prices for comparable goods and services, and if the individuals concerned acted with prudence. Procurement. The applicable procurement procedure must be used. This is not the place to go over procurement regulations, as that could easily be an hour or more unto itself. But Applicable procurement procedures must be followed to ensure that the amount being charged to the grant is not unreasonable. The next factor we will look at is allocation. This is less intuitive than some of the other factors, so it's worth looking specifically at the definition. A cost is allocable if it benefits both the federal award and other work of the non-federal entity and can be distributed in proportions that may be approximated using reasonable methods. Now, a general sense of what it means to allocate is that every cost center should get a fair share. Every activity that the organization does that is benefited by this cost must bear a portion of it. For example, every activity at your organization, including grant-funded and non-grant-funded activities, are benefited when you pay the electric bill, the rent for your office space, the paper you buy, the paper clips you use, etc. Some costs may only benefit certain activities. For example, the cost of placing an ad for hiring a position that works on the grant could be allocated directly. Now, understanding that things should be allocated is the first step. Using a specific method to allocate or accurately split these costs is more of a challenge. Often there is more than one way to allocate something. It just has to be appropriate to the cost, done consistently, and well documented. Again, we don't have time here to work through the math, but I have listed a few examples used throughout our community of how allocation can be done. Which method you use typically depends on what kind of cost it is. For example, square footage. That is allocating based on how much square footage of your facility is used by different activities. This can be a good method for facilities-related costs. Number of participants served. For some costs, you could choose to allocate based on what percentage of total participants were served by the expense. Employee time. For costs related to staff or employees, one method is to allocate costs based on the breakdown of where employees are spending their time, as supported by their timesheets. Again, there is so much that could be covered here, but the specifics will often vary depending on the cost and depending on the agency. Now, it can be very difficult to take what the federal regulations say and understand how they should be applied in real life. As I've said, there is no one way to allocate, which means that there are no step-by-step instructions in the regulations. So I'm going to take some time to go over two examples of allocation using two different methods. These are just two possible ways to go about the process. However, hopefully seeing a more concrete example will make it easier to see how they can be applied to real-life situations. I've created an imaginary agency, the Good Agency, or TGA, to use as our guinea pig. I'm going to create two imaginary expenses for the Good Agency to allocate using two different allocation methods. For example number one, I'm going to use the employee time allocation method. Using this method, an expense is allocated to different activities or cost centers based on how much employee time is spent in each cost center. Now, as you would expect, in order to allocate an expense according to employee time, you must first know where your employees are spending their time so that you have that data to use. It's important to track all activities of TGA's staff. Federal regulations specify that personnel expenses must be tracked so as to encompass both federally assisted and all other activities for which the employee is compensated. We will start by taking a look at how the Good Agency is going about tracking employee time by looking at a sample timesheet. Now, I want to stress that there's more than one way to track employee time, so you do not have to do things in the exact same way as TGA. Here you can see that for this particular 2-week period, employee JS is showing exactly how much time in hours was spent in each eligible activity. The Good Agency only has 2 grants, which makes it easier to allocate than if they had, say, 5. Notice that not only are they separating the 2 grants, they are also separating them by budget lines, such as administration, rental assistance, and supportive services. This way they can ensure that the person's time is being charged correctly among the different budget lines of the grant. They are also tracking time spent on administrative duties that are not specific to any grant, and therefore not eligible to be charged as a direct cost, although these costs could be covered by an indirect cost rate. Lastly, they have a catch-all category for activities that are not eligible to be charged to the grant. Obviously, you can decide to track as many different cost centers as you like, whatever you feel would work best for your individual agency. At the very bottom, it shows what percent of this employee's time was spent on each activity during the period in question. If you were to take this information and combine it with all your other staff, you would have enough information to know how the entire agency is spending time. You can then combine data for a specific period of time, a quarter for example, and have a solid basis for allocating costs based on employee time. Here's what it looks like when the good agency takes all employee timesheets and tracks time spent in each cost center for the whole agency. This report for all employee time in quarter 3 of their 2019 fiscal year is shown here. The good agency has decided to do this quarterly, but you could do it monthly, annually, or a similar time frame that works best for your agency. However, it is important that the information remains accurate, so using data that is more than 1 year old is probably not a good idea. The good agency took the percentage of time spent in each cost center and used the same distribution to allocate costs. In this case, I've used the example of an order of paper. The good agency bought $200 worth of paper from the Dunder Mifflin Company and has used the employee time method to allocate this expense. Here is the breakdown of those costs. TGA now knows exactly how much to allocate to each cost center, and they have solid documentation to back up this allocation. It's important to remember that not only does the allocation itself have to be documented as it is here, but there must also be a record of how these percentages were arrived upon. I stress again that this is not meant to show you exactly how to allocate something, or that you should simply copy everything I have done here. What works for the good agency may not be a good fit for you. There may be a better or more accurate allocation method for you. Also, different kinds of costs may require different allocation methods. I allocated the order of paper using employee time because paper is an employee-specific cost. For example, an empty office uses no paper. Other costs might be much better suited to a different allocation method. I'll briefly discuss one such method: square footage. While determining the amount of square footage used by each activity would be much different than tracking employee time, the principle is the same. Each activity must bear its fair share of the expense. Certain areas of the building could benefit multiple cost centers, the office of an employee who works on 2 grants, for example. So it would be important to account for that when determining how much square footage is devoted to each activity. You could use employee time information to determine how to split an office or similar space that is used for multiple activities. Once the percentage of square footage has been determined, the allocation sheet looks exactly the same, except with different numbers in the center column. The good agency used the square footage method to allocate the electric bill because electricity is used for the entire facility, not just for specific employees. Common areas or large and empty spaces are also counted. Sleeping rooms in a shelter, for example, might account for more than 60% of a building's square footage, while only 20% of employee time is spent on operating or maintaining those rooms. While it can be tempting to use one allocation method for all costs, this must only be done if due diligence has been done to ensure that no other method would produce a more significantly appropriate or more accurate allocation. As I've said, it is very important not only to allocate expenses accurately, but to document how the allocation was arrived upon. This brings me to the final factor of allowability to discuss: adequate documentation. Unfortunately, adequate documentation is also not clearly defined in the federal regulations. Here are some of the elements to consider in order to determine whether or not a transaction is adequately documented. Invoices or receipts showing what was purchased, specific and itemized. It's not enough for an invoice to say that services rendered were performed, because then it's impossible to tell whether the costs were eligible or not. A proof of payment, either a check or bank transfer, confirming that the payment was actually made. Support for allocation, such as the research done to determine the amount of employee time used in quarter 3 in the previous examples. Proper approvals. Many agencies have in their policies and procedures certain signatures or approvals that are necessary for certain types or certain tiers of costs. These approvals must be in place for a transaction to be adequately documented. Lastly, for salaries and wages, timesheets, payroll reports, check stubs, etc. must show what the employees were paid, number one, and the actual work and time they spent on the different cost centers so that we can match up the amount paid with the time worked. This is an area where it is important to coordinate between the finance or accounting staff who are recording transactions and any program or support staff that are making or approving them. Leases are an area where the finance staff is not likely to be involved in the execution of the agreement, but there still must be a process to ensure that payments requested and/or approved are supported by adequate documentation. Obviously, some of these elements will only apply to certain transactions, but not others. The spirit of what is required is that it should be possible to see, step by step, every element of documentation from the time the cost was incurred to the time it was paid. Next, we will discuss a few items that the regulations are refreshingly clear about. These items are always ineligible, although I did sneak in one caveat. Alcoholic beverages, always ineligible. Bad debts or uncollectible accounts, these cannot be written off to charge to the grant. Fines, penalties, damages, and other settlements. This would include any late fees paid by the agency. Those would be ineligible. Fundraising, lobbying, membership in country clubs or social clubs. Now, the last one on the list is membership in civic or community organizations. This is allowable only with prior approval, either from HUD or the pass-through entity, such as Strategies. Salaries and wages have certain specific eligibility requirements that are discussed in their own section of 2 CFR 200. Please note that fringe benefits are covered by a different section of the regulations, and so this is not specific to them. One related cost that we have seen at more than one organization has to do with the incentive compensation. Now, incentives may be charged to the federal grant, but only under certain circumstances, which are shown here. They must be reasonable, and we've already discussed reasonableness. They must be for services rendered rather than a distribution of earnings in excess of costs. And what that means, essentially, is that you can't simply take all the money that's left at the end of the grant, carve it up, and give it out to employees as a bonus. There must be some connection between some accomplishment or some work actually done and the incentive itself. Also, one of the following two conditions must be met. Either C, it must be based on a good faith agreement between employee and agency before services are rendered, or it must be pursuant to an established plan followed by the non-federal entity so consistently as to imply, in effect, an agreement to make such payment. Essentially, if there is not a clear agreement signed beforehand that establishes what the achievement or accomplishment criteria are for incentive pay, then the system in place must be so consistent as to operate as if an agreement is in place. I have also included here the regulatory definition of salaries and wages, although that is pretty intuitive. Something else that is specific to salaries and wages is that there are additional documentation requirements. These requirements include, but are not limited to, records must accurately reflect the work performed. In other words, it is where employees actually worked, not where they were projected or budgeted to work. Internal controls must be in place to ensure accuracy. An example of this would be errors in entering timesheet data into payroll software, or some similar issue where timesheets did not match wages paid. Records must show time spent working on federal grants, as well as time that is not chargeable to the grant. Christmas parties, company outings, baby showers, staff meetings, etc. would fall under this heading. We are often asked if a person's time can be charged to the grant based upon an estimate of how much time they will spend on the grant. The answer is that it can be, but only under certain circumstances. They must offer a reasonable approximation of the work performed. Any significant changes must be recorded in a timely manner. And there must be a process to review after-the-fact interim charges and make adjustments so that the final amount charged to the grant is accurate, allowable, and properly allocated. In other words, at some point before the grant closes, there must be a true-up so that everything matches work actually performed. I've included at the bottom of a page here the full regulatory definition of equipment, but a few important points to make about the definition of equipment are: it is something having a useful life of more than 1 year, and it has a per unit acquisition cost of $5,000, or if lower, if an agency's policies set a lower limit for capitalizing assets. As far as the rules governing equipment, there are too many to thoroughly address or discuss here. The purchase of equipment is governed by several different sections of 2 CFR 200, and the rental and leasing of equipment is discussed separately. In addition, there may be grant-specific requirements for equipment. Basically, the most prudent course of action is to review the regulations thoroughly and discuss with strategies before making the decision to purchase or lease any equipment. Travel costs. Travel costs can be allowable under certain conditions. Note that what I'm discussing here is discussing reimbursement for employee travel, not travel costs paid to participants as supportive services. First, there should be an agency travel policy that sets forth the standards by which employees will be reimbursed for travel, including mileage, hotel, car rental, and airfare if applicable. Also, an agency must follow its own travel policy, as a departure from that would be considered ineligible. There are many regulations governing travel eligibility, but some of the most important are: the cost must be reasonable under the definition of reasonableness discussed earlier. The purpose of the travel must be documented and must be eligible. And approval for the travel should be documented. The level of approval required for travel should be discussed in the agency travel policy. I should note that the regulations governing travel are more strict for the COC grant as well as others, so keep that in mind as you review these requirements. The COC grant, just to use an example, only approves trainings that are HUD approved, and so the cost of attending a training, such as travel to or from the training, would not be eligible for the COC if it was not HUD approved. One last thing that is important to mention about grant eligibility is the question of when. What is the time frame in which a cost is eligible to be charged to the grant? This is known as the period of performance. What the period of performance establishes is: number one, charges are only eligible if they are incurred during the grant's period of performance. Number two, any costs incurred before the grant period, pre-award costs, may be eligible if authorized by the federal awarding agency or pass-through entity in advance. Lastly, period of performance varies based upon grant. The COC grant, for example, lasts from July to June, whereas the ESG and HOPWA grants follow the calendar year, January to December. That would change the period of performance for different grants. If a single expense falls into 2 grant periods or crosses 2 grant timeframes, then the transaction must be prorated based on the amount of time spent in each grant period. For example, if 6 months of an annual subscription fall in one grant year and another 6 months fall in the following year, the expense should be split 50-50 and charged equally to both grants. I do want to make the reminder, just in summary, that this has been a summary of applicable regulations. This is not an exhaustive list of all regulatory requirements to determine grant eligibility. I've gone over a lot of specific information, all of which is very important. There's no way I could go over all the specifics I would like. That would literally take all day. In closing, there are 3 general thoughts that I hope you'll take away from this. Number 1, review the regulations and keep reviewing them. Have multiple people on your team review them and consult them when you have questions. Number 2, set clear policies. And of course, what good are clear policies unless they are followed? A lovely and well-written policy that covers the regulations is no good if it gets stuck in a drawer and gathers dust. Abiding by your own policies and procedures is a regulatory requirement. And number 3, feel free to reach out to us with any questions. We would always rather discuss something in detail before a purchase is made than have to deal with an ineligible charge to the grant. This is the best way to ensure that we are communicating on the same wavelength in regards to what the regulations are. I've listed here the contact information for each member of the compliance department here at Strategies. Feel free to contact us, as I said, by email with any questions that you have. I've also listed, for additional information, the ecfr.gov website, which is a wonderful resource where you can go and actually look up the regulations. Thank you for attending this training on 2 CFR 200 eligibility. If you have any questions, please feel free to contact me or anyone in the compliance department at Strategies, and we will help you as best we can. Thank you very much for attending the training.